If you think getting a mortgage is the hardest part of buying your first home, think again. Hidden costs and approval traps are quietly locking people into payments they didn't fully understand, and I've seen it wreck budgets and dreams. Now, it's not the mortgage itself that should scare you, it's everything surrounding the mortgage that often catches people off guard. And honestly, that's the part no one really prepares you for. I bought my first home back in 2011, right in the middle of the Great Recession. Everyone thought it was crazy. Homes were being lost left and right, yet there we were deciding to jump in without knowing what the future would hold for the market. And like a lot of folks, I didn't really do any homework. My agent was actually the mom of a coworker. When I mentioned buying a house, he said she was an agent, so I figured why not? Zero research from me. So, needless to say, I learned some lessons the expensive way. In the next few minutes, I'm going to share the exact traps that I wish I'd known back then. This way, you can avoid becoming house poor too, sidestep surprises at closing, and avoid getting locked into a financially tight spot. We'll break this down into three big parts: the true cost of homeownership, the mortgage approval trap, and the rules that protect you from making a painful first purchase and having massive buyer's remorse. So, let's start with the part that causes the most financial damage. Most first time buyers don't fail because of the mortgage. They failed because they didn't budget for the full cost of home ownership. I want you to think about the cost of owning a home into two buckets. You have your upfront cost and your ongoing costs. So let's start with the upfront cost. These are things that you have to pay before you even move in. First, your down payment. That's the obvious one. That's the one that everyone focuses on. Your down payment decides what homes are even realistic for you. Here's why this matters. On a $300,000 home, putting 3% down versus 20% down will give you two totally different financial lives. We're talking $9,000 versus $60,000 out of pocket. That gap changes everything about your buying power. It affects your monthly payment, your mortgage insurance, and how much flexibility you have after you buy in your budget. Second are closing costs. This is often the first big financial surprise. You saved up all of that money for a down payment and you find out you need more. Closing costs can usually run anywhere from 2 to 5% of the loan amount. So on that same $300,000 home, you could be looking at 6,000 to 15,000 additional funds needed. And most people don't budget for it. But there is a solution for this. First, make sure you're budgeting worst case here, not best case. So, what you want to do is negotiate with the seller to cover part or all of your closing costs. Based on your loan type, you can negotiate from 3 to 6%, meaning you may not have to come with any closing costs out of pocket at all. This is actually easiest to do with homes that have been sitting on the market a while, have had price cuts, or if you happen to be in a buyer's or a balanced market, it's much easier. You can also ask your lender about rolling closing costs into the loan, but know that increases what you owe long term. Third are other fees that you will need to pay, such as inspections, appraisals, appliances, furniture, and moving costs. These are all one time costs but can easily add up to thousands of dollars. For example, a general inspection can range anywhere from $500 to $600 depending on the age and the size of the home. Then add in an appraisal fee of $500 or more, and you're already at over $1,000 more. So make sure you're budgeting for these items before you start the home buying process. Now, let's talk about bucket number two. Those are the ongoing costs. And this is the real monthly payment that catches people later. So, number one is your mortgage payment. Again, this is the obvious one. This is your principal and interest. This number will stay the same for the life of your loan. But most of the time, when a lender gives you a payment number, it includes more than just principal and interest. It also includes your taxes and insurance. So let's talk about those two expenses because that's where the surprises actually start to happen. So, number two, property taxes. What most people forget, not just first time buyers, is that property taxes can and do rise as home values rise. We saw this a lot during the pandemic boom. People were all excited that their home values were skyrocketing, but that also meant increased taxes by a lot. Yep, even if your interest rate never changes, your payment will go up due to this increase. Number three, homeowners insurance. This is required by the lender, so you don't have an option not to have it. And honestly, I wouldn't recommend that anyways. Again, this is included in your monthly payment as part of your escrow account. Just a quick pause. An escrow account is where that extra money you pay above your principal and interest goes to cover your taxes and insurance. So these are automatically paid for you from your escrow account, so you don't have to worry about them every year. But like property taxes, this number is not set in stone. As home values rose, so did insurance costs. So not only did payments increase because of taxes, they increased because of insurance. I heard insane stories of people's overall payments increasing by hundreds of dollars each month with this double whammy. So you really want to keep an eye on those two things and shop around if you can yearly for your homeowner's insurance to ensure you're getting the best rate and keep that payment down. Number 4 is mortgage insurance. This is not the same as homeowner's insurance. If you put less than 20% for your down payment, you'll likely be required to have mortgage insurance, and this will raise your monthly payment. It's basically a penalty for having a smaller down payment. For FHA loans, this can be 0.45% to 1% of the loan amount. Now, this is rolled into your overall mortgage payment, but it's important to know that it's there. If you're using a conventional loan, this can actually fall off when your principal balance reaches 78% of the home's original value. But with an FHA loan, this will stay on for the life of the loan or until you refinance into a conventional loan. Number 5 are HOA fees. If your home has a homeowners association, there are two costs that can catch people off guard. First, your monthly HOA fees can and often do increase over time. Again, I've seen this a lot more often lately as costs for things like water, maintenance, and insurance have increased for HOAs. And who do you think they pass that on to? Yeah, you. Another cost is special assessment. These are usually one-time, really large fees that cover extensive maintenance to a community. I recently had two clients be hit with special assessments of over $10,000. And while they had an opportunity to vote on it, it came down to the majority. So now they are on the hook for a lot of money. So make sure you are asking about how often and by how much the HOA has increased over the past few years, and if there have been any special assessments. Number 6, maintenance, repairs, and utilities. Welcome to home ownership. The landlord is gone. You're the landlord now. The AC breaks when it's 120 degrees outside. That's on you. The roof leaks. That's on you. Repairs are not if, it's when. And most people are just one major repair away from financial disaster. Utilities can also hit hard. Your 2,000 square foot home requires a whole lot more heat when it's negative 39 out than your 800 square foot apartment. So even before you purchase a home, you should start saving up to have a home and emergency fund to cover these items. Bottom line, you need to ensure you fully understand the cost of home ownership before buying your home. You don't have to have all of this money right away, but having a plan and knowing that they can happen is important to not becoming house poor. If you only budget for the mortgage, you're going to feel rich on paper, but broke in real life. Now, let's talk about mortgage approvals because this is where I see the most regret show up later. Being pre-approved is not permission to go spend like you're on selling sunset. It's simply a bank telling you the maximum amount they are willing to give you based on guidelines and automated systems. It does not tell you the payment that you can comfortably live with without being house poor. Let's break this down. First, know the difference between pre-qualification and pre-approval. A pre-qualification is really just a quick estimate based on the high level information that you provide. It's not verified, it's not guaranteed, it's honestly just a ballpark. You'll get this a lot if you're going through those online lenders. Now, a pre-approval is different. That's verified documentation, it's accurate, it's been submitted for underwriting approval and given the official green go-ahead stamp. And it's often required before sellers will even take you seriously. So if a lender has not asked for all your docs, run. I've unfortunately seen buyers thinking they are pre-approved, fall in love with a home, and get close to getting the keys, only to find out their horrible lender didn't verify everything in advance and they're actually not approved. Don't let this be you. I know it's a pain and feels inconvenient to provide document after document, but I promise it's worth it to avoid heartbreak and disappointment. Second, a pre-approval tells you what you can buy, not what you should buy. My motto for first-time buyers is eligibility is not affordability. Two households can make the same income and need very different payments. One might have no kids and tons of flexibility. Another might have childcare, family obligation, and higher fixed expenses. That's why you decide your comfort payment number, not the lender. So here's a simple affordability rule to protect your life. A safe guideline is keeping your mortgage payment around 30% of your net monthly income, not your gross, and then being very cautious as you move higher than that. Why? Because it prevents you from becoming house poor. That's that feeling where you own a home but can't breathe anywhere else. You're stuck. You can't do the things you love. You can't save, and you're just one emergency away from full house buying regret and needing to max out credit cards. Then starts the financial spiral. Here's the test I always come back to. If the air conditioner goes out, a car repair pops up, or life happens, can you handle it without panic? If the answer is no, the payment is too high. Your first home should give you some financial stability. If it takes your breathing room away for those emergencies, that's not stability, it's a trap. I actually created a calculator that will walk you through how to figure out the number that ensures you don't go broke buying your first home. You can check it out in the description below. Now, the home price matters, but the mortgage type and loan program you choose decides how heavy that home feels every single month. And lately, I'm hearing more chatter about a type of loan I honestly haven't heard much about in a while. So let's break this part down. There are two mortgage options most first time buyers are choosing between: fixed rate mortgages and adjustable rate mortgages. The most common option is a fixed rate mortgage. This is the no surprises loan. Your interest rate stays the same, the principal and interest part of your payment stays the same month after month, year after year. It's easier to budget, it's easier to plan, and yes, it's easier to sleep. Fixed rate loans are usually best for first time buyers who value stability and plan to stay put for a while, because when your payment never changes, life feels more manageable. And surprises are what break first time buyers. Now, with higher rates, I'm hearing more lenders talk about adjustable rate mortgages, or ARMs. So, what's an ARM? Here's the simple version. An ARM starts with a lower interest rate. Your payment is lighter at first. That part feels great. But after a set period of time, usually 5, 7, or 10 years, that rate can change based on the market, which means your payment can go up. That's where the uncertainty comes in. ARMs are not bad loans, but they are not set it and forget it loans either. If you're even considering an ARM, you need to know the worst case payment, not the starting payment. You want to know the highest it can go. If that number makes you nervous, that's your answer, because an ARM only works when there's a clear plan, a refinance plan, a move before it adjusts plan, or an income growth plan. So no plan equals stress, because the goal isn't picking the best loan, it's choosing the loan that fits your life, your timeline, and your tolerance for risk. And that's how you keep a home from feeling heavy. So once you understand how your rate behaves, fixed or adjustable, the next piece is, what kind of loan are you actually using? Because not all mortgages play by the same rules. So what are some loan programs you should understand? We're going to keep this simple. Conventional loans are the most flexible. They work for a wide range of buyers, and here's the big win. Once you reach that 20% equity, mortgage insurance usually drops off. That can lower your payment over time, and that matters. FHA loans are often the entry point. They allow a lower down payment and can be more forgiving with credit, but the trade-off is mortgage insurance sticks around longer and costs more over time. So think of FHA as a great way to get in the door, just not always the forever loan. VA loans are in a league of their own. If you're eligible, this is one of the strongest tools available. Zero down in many cases, no monthly mortgage insurance, incredible long-term value. If you qualify, this option deserves serious consideration. Here's the truth. No loan is good or bad. It's only good or bad for your situation, your income, your savings, your timeline, your stress tolerance. And one more thing that matters more than people realize: shop your lender. Always, but make sure you're shopping them the right way. When you're comparing lenders, you need to ask for a loan estimate from every single one, not a text, not a rough quote, not a payment scribbled in an email. A loan estimate lets you compare apples to apples, because Here's what I see all the time. A lender advertises a lower interest rate and buyers get excited. Lower rate, lower payment feels like a win. But what's hidden in the cost? That lower rate is often being bought down with fees, thousands of dollars buried in the fine print. And because most buyers are focused on the rate and the monthly payment, they never realize what they're actually paying for to get that deal. Same loan, same house, same price, very different total cost. A loan estimate forces transparency. It shows you the interest rate, the lender fees, and what that rate is actually costing you up front. And that's how you avoid overpaying without realizing it. Because the best loan isn't the one with the lowest rate on paper. It's the one that makes sense for your timeline, your cash, and your long-term plan. And that's how you shop smart instead of just shopping hopeful. So, what are some rules that can save you from regret? These have nothing to do with the financial aspect of buying, but everything to do with the psychology of buying. So, rule number one, don't rush the biggest purchase of your life. Pressure leads to bad decisions. Friends, family, agents, and the market can all create this false urgency. If it feels rushed, slow it down. Take it at a pace that feels right for you. Number two, don't fall in love with the house yet. Emotional attachment can cloud judgment. Bidding wars punish emotional buyers. So here's the reframe. Treat your first home like a business decision. Feelings can come later after you get through the negotiations. Rule number three, use a checklist, not vibes here. Write down your must-haves versus your nice-to-have. Rank your priorities before you start touring, because when emotions rise, your checklist keeps you honest. And this is where having the right support really matters, because a great agent is going to kindly remind you of what you said was most important to you. Rule number four, don't use the listing agent to represent you. The listing agent's duty is to the seller. Dual representation creates a conflict of interest, quite frankly. Even if they say they can do it, the reality is it's very, very hard to do. You want someone negotiating only for you, not trying to please both sides. Rule number five, ask questions constantly. No question is too small, no question is too dumb. Write them as they come up. Use the notes app on your phone. Stress drops when you have clear answers and know what to expect next. Rule number six, think beyond single family only. First homes actually don't have to be single family. Multi-family properties can offset your mortgage and start to help you build leverage. Your first home can be a place to live and an investment at the same time. This last trap is where most first-time buyers don't lose money because of the market, but they lose it because of avoidable decisions. So this is where deals go from exciting to serious. Let's talk about inspections, because skipping the step can cost you thousands of dollars down the road. Now, I don't care how competitive the market feels. I don't care if it's a multiple offer situation. Do not waive the inspection. An inspection isn't about nitpicking things. It's about knowing what you're walking into in that home. And here's the part most buyers don't realize. You can actually stay competitive without giving up that protection. One option is shortening the inspection period. Another is offering to accept the home as is contingent on an inspection. That means you're not asking the seller to fix things up front, but you still get eyes in the house. You still get information, and information is power, because walking into a house blind is how small issues turn into five-figure surprises after closing. And let me say this clearly, do not be afraid to ask for repairs. Even if the seller early on says, we're not fixing anything. I actually just helped first-time buyers where the seller was so adamant about that, very firm, very confident, then we did the inspection. Turns out the roof was shot, needed a full replacement. And here's what matters. Once an inspection uncovers a major issue, the seller now has a disclosure problem. If my buyers walked away, the seller would have to tell every future buyer that the roof was trash. That changes the leverage. So after some tense negotiations, the seller caved and replaced the entire roof, not because she wanted to, but because fixing it and moving forward made more sense than starting over. So the takeaway, inspections protect your money, they protect your future, and they protect you from regret. Being competitive doesn't mean being careless, and buying a home should never feel like a gamble. Moisture, termites, roof and foundation, AC and heating systems, electrical, and if it's an older home, get a sewer scope. Now, once you've inspected the home itself, the next layer is what the paperwork and the people around it can tell you. And again, this part gets skipped way too often. So make sure you read the seller disclosures carefully. Seller disclosures are just not filler. They're actually a roadmap. So read them line by line and ask questions when something feels vague, especially when the seller is an investment company or a flip. I see it all the time where they put a general comment like sellers never occupied the home, which is not the same as seller doesn't know anything. If a company bought the home, tore it apart, and put it back together, they absolutely know what issues came up during that process. Plumbing problems, electrical surprises, foundation concerns, permitting issues. Those things matter and they should be disclosed. So don't be afraid to push back for those details because the goal isn't to just buy a pretty house, it's to understand the bones underneath it. Next, go talk to the neighbors. Seriously, neighbors will tell you things a listing never will. Ask about noise, parking, the HOA, and how strict it really is. Flooding during heavy rains, recurring neighborhood issues. People love to talk, and they especially love to talk about their neighborhood. You can also use apps like Nextdoor and local Facebook groups to get the real story because that's where the tea actually is. Once you understand the house and what comes with it, the final step is making sure the area itself supports your life long term. Let's talk neighborhoods because a great house in the wrong place will never feel right. And I know this because I lived it. We once bought a house in an A-rated school district, big, safe, quiet, the kind of suburb everyone tells you is the right choice. On paper, it was perfect. In real life, I hated it. We were constantly driving into Central Phoenix just to feel like ourselves again for our favorite restaurants, breweries, festivals, sporting events. We missed diversity. We missed energy. We missed being able to walk into a neighborhood and feel connected. It wasn't a bad house. It was the wrong neighborhood for our lifestyle. And that's a mistake that's quite frankly hard to undo. So before you commit, run this checklist, not for the house, but for your life. How close are grocery stores, dining, and the places you'll actually go? Do the school districts and boundaries match your needs now and later? For example, we wanted to send our son to a Spanish immersion school, and there weren't very many options that were nearby. What does your daily commute really look like? Not what Google Maps tells you. And look at crime patterns, not just overall crime rates. Are there natural risks like flooding or noise corridors nearby? And what's coming next? Because zoning rules and future development plans matter more than people realize. Remember, the goal isn't just owning a home, it's loving the life that you're living both inside and outside of it. And one last reality check before you move forward: renovations and repairs, because HGTV has lied to us all. If you're planning to do any work, get real quotes, not guesses, not ballpark numbers, not my cousin knows a guy, actually written estimates, because sometimes those numbers will be higher than you're comfortable with, higher than you want to put into that home, higher than what makes sense for your life. That's information doing its job. Reality checks help you realize, okay, this maybe isn't it, and passing on a home because the renovation math doesn't work is a smart decision, not an emotional one. Buying your first home isn't about timing the market. It's about avoiding mistakes you can't undo. Let me leave you with the three-part framework. One, understand the true cost of buying and home ownership before you commit. Two, don't confuse approval with affordability. And three, slow down and protect your decision making. Remember, your first home should give you stability, not stress. So if you're thinking about buying your first home and you want some help walking through this the right way, I actually host a free class called Home Buying 101 where I break this entire process down step by step. You can find it in the link in the description below. And if you're not ready for that, no problem. Stay here, keep learning, and be sure to check out this video next. I'm Heidi Littleton, and I'll see you in the next one.